Welcome to the Ask JT podcast, where we simplify tax, finance, and business decisions for UK business owners. I'm Justin Turner, an accountant, business owner, and author. I'm going to share practical advice and help you run your business more efficiently and keep more of what you earn. Year end isn't exciting. It's admin, it's deadlines, and perhaps it's that awkward call from your accountant. But planning before year end is the one time you can actually control your tax bill. So I'm going to give you 7 simple checks that are going to stop kind of surprises, keep more cash in your pocket, and make next year smoother than this one. I've guided loads of small business owners through year end, and I suppose here's the truth. If you sat with your accountant 8 months after the end of the year end, still asking what your tax bill is going to be, it's time for a new approach. I'm going to take you through these 7 key checks that you've got to do, and they're pensions, tax forecasts, director's loan, capital spending, bad debts, dividends, and planning ahead. Each one's fairly straightforward. It's proven and designed to keep your business healthy, and I'll take you through them all today in plain English. So to start us off, let's talk about pension contributions and savings. This could be a really big win for your company. If your company's got spare cash, don't let it just rot in the bank account. Move it into your pension. The company gets tax relief, and you'll get a long-term payoff as well. Let's say, for example, you put £10,000 into your pension. If you're paying 25% corporation tax, that's £2,500 less corporation tax. It's brilliant. And you don't have a single penny to pay in income tax or national insurance. It's particularly important as you start approaching retirement. I suppose, would you rather build your future or boost HMRC's profits? Make sure the cash leaves the company before the year end. But let's be realistic. You can't always put everything into pensions. You're still going to need some cash left in your business, so you can't deploy it all into your pension. But still, don't let that cash sit idle. Open a proper business savings account. Right now, my company's getting 3.48%, and just from normal working capital movements, that's about £70 to £100 a month in interest that I'm earning, and I'm doing nothing, and it's no risk at all. My next idea for you is about tax forecasts. We don't like surprises. Most directors only find out their tax bill months after the year end. By then, it's too late to do anything about it. You need to start the process a few months before the year end. A client said to me something recently that really stuck with me. He called his last accountant an archaeologist because all he ever did was dig through the past. And I had another business owner the other day ring me up last week, and he said, can I top up my pension? What do you think my corporation tax bill is going to be? But he hadn't done any bookkeeping for the last 4 months. I suppose that's the key here is with today's technology, it's never been actually easier to keep up to date with your record keeping. And there's some key questions that you've got to ask yourself. And those 2 examples are absolutely prime. Are your records actually up to date and current? Do you know your actual year end date for your company? For personal tax, it's always the 5th of April. For companies, it depends on when you've incorporated. But you'd be surprised how many people just don't know their year end date. Think about, can I actually run a profit and loss for my business today and estimate what my corporation tax would be? Coming towards end of year, do you have enough set aside for PAYE and VAT liabilities? How much working capital do you think you're going to need for next year? Is there room for pension contributions or capital purchases before the year end? 80% of tax stress is coming from 20% of the surprises. These questions are going to keep you well away from the surprises. Just ask them in advance of year end. So the next point is about directors' loans, and I want you to avoid the 33% tax trap. So let's talk about probably the most misunderstood part of a small company's finances. Is if you've borrowed money from your company, even just covered a personal expense, you've got 9 months in which to pay it back. If you miss that window, an HMRC will ultimately charge you 33.75% tax on the balance under something called Section 455. That's cash your business won't see again until the loan has been repaid. And do you really want HMRC earning interest on your cash? Now, here's where most people slip up. A director's loan feels like easy access to cash, and technically it is. If you repay it within the 9 months rule, there's no immediate tax bill. But once it sits unpaid, it hits everything: your cash flow, your tax, and even your company reputation. An overdrawn director's loan account shows up on your balance sheet publicly. And lenders and buyers might see that as a red flag. It says, the director can't live within the company's means. I've seen deals fall apart because the buyer refused to complete until the director's loan was cleared. It hadn't been disclosed properly. Banks could also spot that and sort of pull back on lending if they spot that a director's loan is overdrawn. Quite often, underwriters don't really understand what a director's loan really is because they've never really run a business. So try and avoid showing a director's loan at the year end. So what are the smart moves here? Firstly, remember your company isn't your personal bank. Use director's loan accounts absolutely sparingly and have a clear repayment plan. Second, keep your bookkeeping tight. Real-time management accounts are going to tell you whether you can actually afford to take cash out. Third, instead of leaning on the director's loans, build a habit of taking small, regular dividends or a PAYE salary when profits are allowing for it. It's cleaner, it's more transparent, and it's far better for tax and credibility. And if you're unsure where you stand, get a tax advisor or an accountant to walk you through your director's loan balance and your repayment timeline. I've got a full video coming up soon that dives really deeply into director's loans, so make sure you've subscribed to check that when it drops. A director's loan isn't free money, it's borrowed time, so treat it that way. My next point is about capital expenditure and spending smartly. If you need new kit like computers or a new van, buy them before the year end and claim your 100% annual investment allowance. So if you spent £5,000, you'll save around £1,250 in tax. But here's the golden rule: only buy what earns or saves more next year. Never spend money just to reduce tax. Buy assets that give you commercial advantage. That's assets that will generate more profit or replace aging kit before it breaks. £5,000 gadget that doesn't make money isn't an investment, it's clutter. My next part's about bad debts, stock, and some general housekeeping. Basically, you want to kind of clear the slate. So I want you to check your debtors. If someone definitely isn't going to pay, then write it off before year end. That gives you corporation tax relief and tidy your accounts. If you're on accrual VAT, it might even actually reduce your next VAT bill as well. I think keeping bad debt on your balance sheet is just vanity. I know you might still be hoping to recover it, but it's rarely realistic. We wrote off £1,000 debt 2 years ago, and the liquidator just the other day sent us £4.92. I think you've just got to be honest with yourself. If it's gone, it's gone. It's the same with old stock. Do a proper stock check. One client discovered a couple of shelves of product that were past their use-by date. Writing it off saved tax and stopped him buying stock that he couldn't sell in the future. Another client told me his old accountant had never asked about stock, and he'd showed about £5,000 of stock in his accounts. When I asked him what the real figure was, it turned out to be £70,000. That one correction created a large unexpected tax headache. And don't forget about the timing items. If you build work in advance, move it into work in progress so it's shown in next year's figures, not this one. That adjustment alone saved one of my clients paying tax at the marginal rate of 26.5%. But also look the other way. If you've done work and you haven't billed for it yet, get those invoices raised before year end. Yes, it might increase your tax this year, but it shows the truth. Clean, honest accounts are far more valuable in the long run. My message here is simple. Treat the year end like a spring clean for your balance sheet. If a customer's gone bust or stock's gone stale, keeping it on the books isn't going to bring it back later, and it's not going to do you any favours either. My next point is about how to take dividends without getting burnt. So let's clear something up. Dividends do not reduce your tax bill. Dividends are simply how you take profit after the company's paid corporation tax. A dividend isn't a clever loophole. It's a payout, but only if there's enough profit left in the tank. I see at least one client every single month who's taken too much money out of the company. They say, "Oh, but Justin, there was money left in the bank account." Yeah, sure there was, because you still haven't paid HMRC for your corporation tax. And once you've paid that, there might not be any profit left for dividends. Plus, you could end up with an overdrawn director's loan account and a huge tax headache to match. So how do you take dividends properly? So here's your checklist. Number 1, check your accounts. Has the company actually made or retained profits after corporation tax? That's what you're going to be paying dividends from. And it's going back to that same point I made earlier about, are your records up to date and accurate? Next thing is, I want you to hold a board meeting. Yes, even if you're the only director. If there's multiple shareholders, then creating a simple dividend voucher and a few minutes from a meeting, it's going to keep everything tidy and compliant. Honestly, it's not arduous. It takes 2 minutes. The next point is about paying it properly. Transfer the money from the company to your personal account. Label it dividend. If you ever saw my personal bank statement, that's exactly how it's going to appear. And here's a bonus. Underwriters for mortgage companies love to see that clear movement of money. If you skip any of these kind of tips, then HMRC, a liquidator, a divorce lawyer could look and argue that a dividend wasn't actually payable and it should be treated as salary, a loan, or potentially a legal distribution. And that's when the tax situation really bites hard. Bottom line here is, dividends don't reduce tax. They just help you take profits out of the company cleanly, and they're helping you avoid employers' national insurance. Make sure your records are watertight. Dividend isn't the danger, it's the missing paperwork and the missing profit that can cause the pain. My next point is, I want you to plan ahead. Next year starts now. Year end isn't just a finish line. It's kind of a reset button. I want you to ask yourself a few questions. Do you need to change your salary versus dividends, sometimes referred to as your remuneration strategy? I'm recording this kind of a little bit before the budget. So, things might happen within that budget that require you to change your approach. Ask yourself things like, should I hold a cash buffer? Is it time to set up a holding company as we grow? Directors who stay ahead use year end as almost like a checkpoint. It's not a deadline for them. Year end doesn't really end for them. It's just the start of the next 12 months. And they're starting that 12 months on purpose with a strategy. And that's what you need to do as well. So there you are. They're my 7 tips for year end. We've gone through pensions, forecasts, loans, spending, debts, dividends, and planning. If you handle these well, that you're going to save tax, you're going to free up cash, and you'll walk into the next year with kind of fewer surprises. If you're looking for some more easy wins, I've got a little book called 10 Ideas to Save 10% in 10 Minutes available on Amazon. I'll put a link in the description. Before you go, drop me a comment below. What kind of one lesson you wish you'd learned sooner about year end? I'll see you next time, and good luck with your year end. Thanks for listening to the Ask JT podcast. Subscribe for a weekly episode, and if you found this useful, share it with a fellow business owner who might benefit.